Good morning, Campbell McCrary here, Amvest Capital, New York City. Welcome to the Amvest Capital Inc. live webinar with Westfault Mining. Westfault trades on the venture as WVM and on the OTCQX as WVMDF. We hope you'll enjoy today's program. It'll also be available in replay mode. You'll get it in an email, the link, although the original link will work for it, and at our website, amvestcapital.com/replays. Please note this call, Amvest is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. Do note this call is most definitely for informational purposes only. Please, we ask soliciting people for questions. Please send your questions in the question pane to the GoToWebinar control panel, and we'll ask them. No question too micro or macro here. I have today Mike Jones, who's the president, CEO, and a director of the company, and Frank Hallam, the CFO and corporate secretary. They both worked together for a very long time and had some great names associated with them. With that, Mike, if you want to share your screen, we'll dig in and then we'll see you on the other side.
All right, just check for me, Campbell, that this is working.
I see it. Just pull up maximize your presentation.
Okay, your smiling face is in my way of doing that, but I'm working on it.
Yeah,
sorry.
Click on it and move it out of the way.
Yeah, no, I'm trying to. There we go.
Yeah.
Well, thanks for the opportunity, Campbell. And it's a very exciting time for gold. And this is a great way to own some gold safe in Nevada. It's a very well-owned company and with great institutional support. And this is a very safe long-term way to own gold, as I said. So standard forward-looking statement caution. We're listed on the TSV-V. We're also on the over-the-counter market in the United States. And we will make reference to certain information relative to Canadian standards on reserves and resources. So these are proven and probable reserves in Nevada, trading at a very significant discount to their value. So it's a very simple project. It's, sorry, I've just got a lot of alarms coming in here.
I think that got rid of them. Okay.
I'm trying to, yeah. So not sure why all of a sudden my email started updating. Okay. It's a very simple project, all oxide heap leach in Nevada. After tax, $1,800 gold. The net present value here is $295 million. It's 92% internal rate of return, and there's $5 US a share in net present value as calculated by our independent engineers. Stock's trading at about $1 US. So you're literally able to buy gold here at 0.2 times the net asset value. Another way to look at this is $1 to buy a share would buy you 0.01 ounces in proven, probable, and recoverable gold. So this is a way at $1 a share to buy $20 worth of gold in the ground, recoverable in Nevada. Excellent exposure to gold and leverage to gold. Really quite a unique opportunity that way. These are very high margin reserves at an all-in sustaining cost of $709 an ounce with a low capex of $47 million. The project is fully permitted. Took us 3 years. It was completed in November 2020. And as I say, there's 577,000 ounces of gold. So that's the investor that we're looking for, is an investor that understands the leverage to gold and sees this as a very inexpensive, safe, secure, conservatively managed way to own gold with extraordinary leverage to the gold price. Some project milestones that we've completed. We bought out our private partner, Waterton, 25% interest in August 2020. In November 2020, we completed the federal permit on our second phase of mining operations, the first phase already being permitted. And then in January 2021, we acquired the Hill of Gold deposit, adding another 43,000 ounces in a historical inferred resource. That was very accretive to us and can be added to the Three Hills first pad that's permitted. And then in March 2021, we sold a stream to Sprott, replacing a previous royalty that we had bought and held internally. We sold a stream to Sprott for 1.41% of the gold, a very accretive transaction for $7.3 million, including a $6 million upfront payment. In terms of, there's an option on this stream to add the Hill of Gold for another $300,000. And the cash transfer price to Sprott for those ounces is 20% of the gold, 20% of the gold price at the time. And it replaces, as I said, or offsets a 1.1% NSR that we acquired from Newmont in 2017. So this, again, considering that we're trading at a 0.2 times NAV, this is a very accretive transaction. This is another way of looking at it, and investors should note that there's a very good independent technical due diligence done here in the purchase of this stream, and the valuation that it was done on is 0.74 times the net asset value, whereas you can buy Westvault stock at 0.2 times the net asset value, even though the stream was bought by a very sophisticated investor. So that highlights the leverage and opportunity to a shareholder today. This is where the project's located. It's about 3 hours north of Las Vegas. It's north of the Sterling mine, where I actually mined heap leach for 6 years there. So I'm very familiar with this district and have run a heap leach gold mine in the very area that we're talking about. There's been a fair amount of activity around the area. Recently, a company picked up the Bullfrog asset, which was a former producing gold mine owned by Barrick. It's now being looked at again. Scorpio Gold has the Mineral Ridge deposit not far from us, and Kinross to the north. It's a very large land position that Westvault controls. Excellent infrastructure. It's just off Highway 95. There are 3 deposits in this area, which we all control 100%. And there's a very good opportunity to expand resources here with the high-grade route at Hasbrouck deposit, which I'll show in a minute. Again, this is very simple mining. So it's open pit mining with heap leach extraction. This is a model of the Three Hills area, which will be mined first and is fully permitted. There's room on our purchased surface rights to expand our heap leach potential area, which will allow us to add the Three Hills, the Hill of Gold deposit onto the heaps. There is some exploration potential around Three Hills, but again, the focus here is on conservative management and conserving the value of gold. The facility at Hasbrouck, now also fully permitted. It does have crushing, whereas the first phase of mining is actually with just run-of-mine material. And the heap leach facility, again, located near the open pit. The resource overall is just under 1 million ounces, so it's a very good scale for investors. And on proven and probable reserves, that's 762,000 ounces, and including the metallurgical recovery, which is quite good, 577,000 ounces recoverable. The profile of productions over 8 years, we're very confident that we'll be able to extend that beyond out to years 9 and 10, given the route of the Hasbrouck deposit. And our Hill of Gold deposit becomes very useful to fill in that year 3 production, but a very quick ramp up in year 2 up to 83,000 ounces of gold. The overall construction period, by the way, is 1 year. So at the right time for gold, we can put this deposit into production and maximize the value to shareholders. And again, right now, 1 share represents about $20 worth of gold at the current gold price. If you escalate the gold price up to, say, $2,500 an ounce, you move that up to $25 per share, and so on. $3,000 gold, which we do believe over the medium term and certainly the term of this startup of operations is possible. That puts you at something like $30 a share in gold. This is the Hasbrouck larger deposit, just showing the cross section of the reserves. And there are intersections at the base of the deposit which are not extended in the current mine plan, something like 154 feet of 0.12 ounces. That high-grade route has not been explored because it's awkward to get at from the surface of the hill, but it does offer excellent potential. And again, from a company strategy point of view, we're not spending high risk and high cost dollars to drill this route. We know we'll be able to mine it and return that value to shareholders. Some of the technical details on the project, it's a 0.6 gram grade, which is relatively low grade, but an extremely low strip ratio at 0.9 to 1 on the Three Hills mine and 1.1 to 1 on the larger Hasbrouck deposit. Excellent straightforward heap leach recovery. There's no deleterious elements or challenges with the heap leach. It's a 75% recovery that's estimated. And average gold production 74,000 ounces a year. What makes this project so extraordinary is the quick access, the low capital cost, and the low operating cost of these ounces because they're sitting essentially in a couple of hills or three hills. There's excellent leverage to the gold price and excellent leverage to the current share market cap. So we're sitting at something like $60 million worth of market cap versus a net present value in Canadian dollars, which we're trading at on the TSV-V, of $372 million at a 5% discount rate, or $295 million US at $1,800 gold. And you can see the leverage as the gold price moves up even $200 in that chart. Because of the unique nature of this deposit and its conservative management structure and management positioning of the asset, with a focus on returning gold value to shareholders, that's attracted some quite senior investors. So the Sun Valley Gold Fund owns 46% of the issued and outstanding shares. Ruffer in the UK owns 13%. Eric Sprott in Toronto, a renowned gold investor, recently bought 5% of the company. And Conwave in Europe and in Switzerland owns 3%. So we're very well institutionally owned and very well backed. We have 58 million shares outstanding. And as we were saying at the beginning, that represents about 0.01 ounces per share, or about just under $20 a share US in gold per share. Market capitalization sitting at about 70 million Canadian, or about 60 million US. Peter Palmetto, who's the head of the Sun Valley Gold Fund, owning 46% of the stock, is our chairman. So you have a very good alignment of shareholder value focus and management of the company. Pierre Ledebelle is the chairman of Imperial Metals Corporation and a very experienced operator in open pit. Kevin Falcon is a director of the company. He's the former deputy premier of the province of British Columbia. Unfortunately, he just recently announced that he's running for the Liberal leadership in the province of BC. So if he becomes premier, which I do expect he probably will someday soon, we might lose him as a director, but he's been a very diligent chairman of our audit committee. And Frank Hallam, who's also on the call here, is the chief financial officer. Sandy McVeigh, with over 30 years of construction experience, is our chief operating officer. So we're in position with people with experience, able to put this property into production at any time. And we're asked quite often, when are we going to do that? The answer to that question is when it's extremely compelling. And we believe that the gold price will continue to move ahead over the next few years, and that this asset will become more and more compelling. That allows us, with a patient approach, to maximize the value of this gold per share to shareholders. So this is quite different than a lot of junior gold companies you might hear presentations from. But the conservative nature of keeping costs extremely low and conserving value in gold to shareholders is our strategy. So the way to look at this is it's a very safe, long-term investment in gold, fully permitted. It's a very solid gold in the ground store of value. We're trading at a deeply discounted price. We're highly leveraged to the gold price. We've kept our annual holding costs here less than 0.2% of the gold value. This is significantly less than buying, say, the ETF in gold. Shareholders and management are extremely aligned because of our structure, and we are ready to build this when the economics are compelling or enter into an M&A process. That's really the quick summary of the project and the company, and certainly interested to hear questions.
Sure. Thanks, Mike. Thank you all for sending in your questions. Please, if you haven't, send in some more. We'll get to them. What's your recovery percentage for gold and silver? If you could highlight that again. And if you might as well share your presentation in full screen mode so we get a better visual.
Sure, just give 1 second here. Yeah, so the overall recovery is 74%. I'll just go to that slide. So 75.7, it's 74% on the larger Hasbrouck deposit and 81.5% on gold on the Three Hills mine, which we start with. On silver, we have a relatively modest recovery, and we only recover silver in the case of the Hasbrouck mine, but it's not significant from an economics point of view. We do have a silver credit, but really this is a gold mine from an economic point of view.
What will you do about your need for water to do mining?
Great question. Thank you for that question. So we have a secured water right for all the water we need. And that's in the northern basin, which is where the Three Hills deposit sits. So one of the challenges we had to go through in permitting is you're not allowed to transfer water from one hydrologic basin to another unless you have the permit of the state engineer, which we went and got. So we have the water rights secured, and we have the water able to be transferred to the southern basin as well. In the latter part of the mine life, we may end up needing a further water right, but there's actually plenty of water available in the basin for sale. So we're negotiating with a number of parties for water beyond into 2028 and beyond in those years. But certainly for the initial years of the mine life, we've got all the water we need.
Do you regularly get in front of value investors? And I'll add on a sort of what points do you highlight when you're in a value institution, and what resonates?
Well, actually, yeah, that's an interesting way of asking that question. I think this is an opportunity to appeal specifically to value investors. You know, we're not spending a lot of money on exploration. We're not spending any money on exploration. This is value of gold in the ground, ready to go into production at the right time or to do an M&A deal. And so we're not interested in dilution. We've got plenty of cash. We've got over $6 million in cash. We could run this company in its current format for 6 years and not issue a share. So defending value is exactly what we're about. And I think if there's an opportunity here to see share price appreciation, it's actually around exposing the company to more value investors. So this is an area where we have to find the right investor that understands gold, believes in gold price over the medium and long term, and sees this as a very value-oriented way to own safe gold.
Thank you. Pass it over to Artie and Adam. And oh, sorry, Stuart first.
Yeah, thanks for that presentation, Mike. The permitting process, how long did that take you guys? And, you know, are there any costs related to keeping that permit in good condition?
So it took us 3 years and several $1 million. And that was the rapid short form process on both projects. So we went under the EA process rather than a full EIS for both deposits, and we permitted them separately. So the rapid process right now is taking approximately 3 years. I think if you're super well organized and really know what you're doing, you know, that used to be the long process. I would say that's the short process now. And no, there's no significant cost of keeping those permits in good standing. Our only significant cost is claim holding costs for non-patented land, which everybody faces. But again, we run the entire company, maintaining the permits, all the G&A, overhead. There's no full-time CEO. There's no full-time CFO. The chief operating officer is also on part-time pay. We run the entire company with public company audit and all the filings for under $1 million a year.
That's great. And then if you were to update the feasibility study today, would there be any work streams you'd do differently or have a new focus on?
The only thing that the project is actually sits under officially a pre-feasibility study. The only area that we could look at is taking the project to feasibility study, and the only thing we would have to do workstream wise is geotech drilling on the Hasbrouck pit, and it would allow us to steepen the pit walls from where they are now at 45 degrees and steepen them to go a bit deeper. But that's the only aspect of the project that requires any work to get to feasibility study, and all of the other work is in excess of feasibility because we have construction level drawings, construction level schedules, and construction level capital cost. So we're ready to construct this. We could start tomorrow morning.
All right. And then the recently acquired Hill of Gold project, do you have any exploration plans there this year?
No, so it's a resource that there is some upside on the north side of the current historic resource. It was drilled by Phelps Dodge with 68 holes, so it's very well drilled and it was good quality work, even though it's historic. There was metallurgical work done and there is a good pit design, so we're just going to go and mine that and put it on the heap as a sweetener. It's really just and it will probably grow, but again, that's dilution by issuing shares to fund exploration at 0.2 times NAV, which is not a good use of shares and value.
Sure. Yeah, thanks for that. I'll pass on to Artie.
Sure.
Thank you. When we look at the total cost for this project, the total amount of the cash and the shares you issued to them, what will be the current value of that in dollar terms?
I don't quite. Oh, you mean you're talking about the acquisition cost plus all of the work that we've put in?
Actually, just the cost for you to acquire.
So we bought originally a 75% interest, and we bought that from Allied Nevada just before they went under. And I'm trying to remember the purchase price now. It was so long ago. Frank, maybe you can help me if you're on.
Yeah, as I recall, it was wasn't it 20 million US?
Yeah, that's what I had in my mind. So 20 million US for a 75% interest, and then we bought Waterton out for $10 million for a 25% interest.
Yeah, $10 million in cash and a million shares, which at that time was roughly $1 million as well.
Yeah.
Thank you.
So,
do you have an idea how much cyanide consumption for 1 ton of ore?
Yes, I do, but I can't remember it off the top of my head. The number 14 pounds sits in my head, but it's like vague. So if that sounds like a lot, it's wrong. But that's the number I remember. All I remember is that it's an average number. It's very, very customary. There's nothing unusual about it.
Okay, it's not eye-catching. And when we look at this crush size, trade-off between the crush size and the recovery, can you please comment on that, please?
Sure. So for the Three Hills pit, there's no difference. You can run of mine, or you can crush it to 1/4 inch or less. It doesn't make any difference, and all of that test work has been done. So Three Hills is run of mine, and we did a bulk sample actually run of mine, and you get 82% of the gold no matter what you do to it. It just comes out. And it's the rock, number one, falls apart. Number two, it's super porous and it just leaches. So there's no point in crushing Three Hills material. It just leaches to 82% at any size fraction. Doesn't matter. On Hasbrouck, it's different. The more you crush it, the more gold you get out of it. So we've got 3-stage crushing, including an HPGR. And that HPGR versus conventional crushing gives us about a 7% bump in recovery, and we have HPGR tested it specifically. But if you're not a fan of HPGR and you don't want to do that, you can save $4.5 million worth of capital cost, and you can bring the gold recovery down by 7%. It makes more money the other way, but it's up to you. Our view is that the HPGR will work extremely well, and it's worth it. And it's the microfracturing that's getting the extra recovery, not necessarily size.
Is that happening because of the silver content at the Hasbrouck, or?
No, it's the silica. It's the amount. It's how hard it is. The more you bust it, the more access you get to surface. The more recovery you get.
Okay, thank you. And then when we look at this Sprott deal, I was reading the deal and I saw something. You took the old Newmont deal to do as a benchmark. Can you please explain that?
Sure. So we bought from Newmont 1% royalty that they held, and what we did was this was Frank's deal. Actually, it was genius. They coveted a piece of exploration ground in the Long Canyon trend that we had. We'd evaluated it. We didn't think it was worth a lot, and we knew that they wanted it, so we traded them the exploration ground in exchange for a 1.1% royalty over our own ground. Now, at that time, Waterton owned 25% of the project. We owned 75%. So we just kept that royalty there because it was over our own property, which we only owned 75% of. But when we did that, the royalty companies came to us and said, hey, can we buy that royalty you bought from Newmont? We said, hey, there's a lot of interest in this royalty. So we put it up for sale. So we got bids and interest on that royalty, but one of the parties that came to us was Sprott, that said, look, can we make this a stream instead of a royalty? So we actually hold the royalty still, but it's over a property that we own 100% of. So it's a royalty ourselves. It just goes around in a circle. So rather than sell the royalty itself, we kind of recreated it as a stream because that's the structure that Sprott wanted. And we just kept the royalty in our own hands and recreated a stream that's the equivalent. It's the equivalent of the same size. So that's the rationale. And it was valued at 0.74 times NAV. That's what we sold that stream for, is at the rating of 0.74 times NAV, which was super accretive because our shares are trading at 0.2 times NAV.
Thank you. And how much work they have done in terms of technical due diligence when they were doing this deal, Sprott?
They crawled up inside it and out its mouth.
Mm-hmm.
So
okay.
Lots.
Right. Thank you. Adam?
Thanks, Artie. Hey, Mike, how you doing?
Good, man.
Hey, couple of quick questions for you. Can you just go over the estimated capex and opex numbers?
Sure. So in terms of the capex is actually the full capex is more than the peak funding we talk about. So it's important to note that when we talk about $47 million as the capex, it's the initial capex. So because there's no crushing circuit at Three Hills and you make money from that, the peak funding is $47 million. But there's another $80 million that you need to set up the whole three-phase crushing, including the HPGR at Hasbrouck. But you fund that out of cash flow. So the cash flow curve kind of has a camel's hump in it, where you put $47 million in, you get all that back, you get a good IRR on that return, and then you take some of that money and you turn it around again into the Hasbrouck mine. So, and the chief aspects of the capital are really around civils for the heap leach area and the crushing unit at Hasbrouck. That's really what capital is all about. There's no, and we deferred about $4 million or so. We deferred the stripping unit. It's permitted, but it's deferred. We deferred the stripping unit for for Three Hills, because it's cheaper just to ship the carbon, because Three Hills, you're just there for 2 years, 2.5 years. So we can defer that $4 million of capital into the second phase. But once you're at Hasbrouck, you're big enough and there for long enough that you want to strip your own carbon. So that unit is then part of the capital in Hasbrouck.
Where are you guys planning on sending the initial carbon for stripping?
There's a couple of different places for competitive reasons. We wouldn't say that on the call, but we've got live quotes on where to strip that carbon. So there are places to send it.
Because you know, that can be an issue. Obviously, you guys, you're going to initially invest the 47 million, and you want to be making that back. If some of that carbon, you know, is sitting there because you can't, the guys that you know, you don't have control of your own stripping, that can be a cash issue.
Yeah, and you would just simply put the additional $4 million in to strip it yourself, which we're permitted for. So
yeah,
it's a $4 million. It's not a project fatal issue. It's a $4 million issue.
Maybe buy that ahead of time, set it up at Hasbrouck just in case or something.
Yeah, you can work it into your cash flow, but there's multiple places it can go, and we're sure.
And then maybe talk a little bit about the OPEX specifically at Hasbrouck. You know, when you have the 3-stage crush plus the HPGR, and obviously that's some hard rock and going to be abrasive and whatnot.
Yeah, so all that's been well done. There were 12 rounds of metallurgical study. Hasbrouck's been taken all the way from run of mine all the way to milling it. So we know the characteristics of everything and every point of recovery along the process. So and the work index and the abrasiveness of all that was factored into the steel cost and all of the crushing. So that's all well factored in.
Just something that struck me, and Mike, is you've got at $1,800. You said there was a 92% IRR or something like that on that slide.
Yeah, that's interesting, but not compelling.
Well, we just crossed 1900 this morning. So when does it go?
Okay, good.
How much of an IRR do you need to be compelling?
We think that we're going to see a new secular high in gold over $2,000, and that might get us get attention. And you know, more than 100% internal rate of return probably gets us interested.
Okay. And can you just quickly go through? You know, you talked about some of the you know, the work, all the crushing work you did, test work you did at Hasbrouck. Can you just go through some of that in greater detail as far as you know, the type of work you guys did and the results from that work, and if you've done it for I think you've got you know, sort of multiple types of ore, if I'm remembering right, at Hasbrouck.
Right.
And as you go deeper, you know, how well is that characterized?
Yeah, so that's so on Three Hills. Obviously, there's been several rounds of crushing studies at all kinds of different size fractions done at both McClellan and Kappes Cassidy, and that's the reason we went run of mine. And then when we decided run of mine, we went and took a 20-ton sample, and we actually did a 20-ton bulk sample on the Three Hills material to determine that we wanted to go with run of mine. At Hasbrouck, again, it's been run through more than half a dozen different crushing regimes with different equipment, wear indexes, all that sort of stuff. Again, McClellan and Kappes Cassidy both. For the HPGR, that was done at Kappes, and it was done with an existing HPGR unit in Reno. And we ran several runs through the machine to look at wear index on the studs and crush sizes and what fine material it created. Are there any issues with that? And you know, that's where we determined that yes, the HPGR was the way to go to get that extra 7% of recovery. You know, again, there's so much margin on the project that if you're, as I said at the beginning, if you're not an HPGR fan, don't put it in. It's fine. You can cut the capital cost, and you know, your IRR is slightly lower, but you know, so what? You know, we think we're very, very well tested with over 12 rounds of metallurgical testing, and we know what this material looks like and how it behaves. We have not done a bulk. Well, one thing I will say though, we haven't done a bulk sample at Hasbrouck, but we have time to do that too. Don't forget, we have a year of construction and 2.5 years of mining at Three Hills. If we wanted to go and refine our crushing regime, we've got plenty of time to do that.
I have a vague recollection, Mike, of the sort of the deeper stuff at Hasbrouck towards the end of life or beyond the end of life. The recovery numbers sort of had a pretty big distribution. Is that because you guys are maybe getting into some sulfide or refractory ores, you know, down deep there?
That's a good question. Yeah, and I should have mentioned that. So I've actually looked at core right through Hasbrouck from stem to stern very carefully and looking for that oxide sulfide transition zone. And in many hours of looking at core, I managed to find one piece of pyrite about the size of a match head. That's it. So there is no sulfide here. The water table is 1,000 feet below you. And this is oxide, very well oxidized material. There's no interplay of sulfide. The issues around recovery have to do with silicification and level of crushing. So again, the more you crush it, the more gold you get out, and that's the only variable really in the recovery. And in fact, the regime for recovery is very conservative because it assumes that all of it is quite well silicified, and you'll probably get a bump in some of the upper material that's not as silicified as what the design was done on.
So if you're running everything through three-stage crush HPGR, you know, you think that the distribution of those recoveries, you know, will be tighter than maybe in the initial work implied, because you were doing it under different crushing regimes.
Exactly, and the conservative, harder, more silicified number was used. So there's opportunity actually in slightly less. It's not the other way around. It's not assuming the less silicified material. It's assuming the harder material that needs the crushing.
And Mike, there's a lot of old mines and showings and whatnot to the east on that map that you put out. That's off of your property, you know, at Hasbrouck. Is there potential there, and who owns that ground, or is that open ground, or you just don't see the potential? What's the thought process there?
So right on our ground itself at Hasbrouck, there's a historic silver gold mine that ran for about 30 years. So there's a deep vein system there. It's actually a different geological age, and it's a different system, and it's the reason that Tonopah is there is the historic silver district. And a company that some investors might know, Blackstone, is actually busy drilling some of those old veins in the district. We have one of the historic producers on our ground. Again, our view is that that's high risk exploration. Those veins pinched and swelled all over the place historically in the district, and that's not a game we're going to play with our shareholders' value in gold, but it is a long-term value potential for the company, is the older silver vein system. In the immediate area of Hasbrouck, there are some historic gold workings in that area. Unfortunately, we spent probably about $1 million initially in the district evaluating that, and we could not tie together another significant resource. There's good opportunity with surface showings with gold, but when we drilled 10 or 20 holes, we couldn't confirm it. And there's a fair amount of historical gold work in the district as well, by other companies. There was a $4 million expenditure just north of Hasbrouck, which we evaluated all those drill holes. And again, that there's potential there, but it's very high risk against a very certain value in gold that we hold. So it's a very different strategy than a typical exploration company. Yes, there's potential, but it's not potential that's within our risk portfolio.
Have you guys run geophysics or anything like that, so you can maybe discern, these silver-rich veinlets from your more disseminated oxide gold, in areas on the property that you haven't really dug into?
So there's been MAG, IP, CSAMT, all of that done. And yes, you can see those structures. And at the end of the day, you got to drill them. And drilling is money, and money is risk. And that's not what our shareholders want out of this company and asset. This is about return of gold to the investor.
Yeah, nothing in geophysics that looks like it matches Hasbrouck that you could, do a low cost, RC hole into.
You can see Hasbrouck, and you can see the silicification system, and we know that there's a route there, and we know that there are intercepts of 150 feet of 0.2. Putting that into reserve will cost you $1 million, and $1 million is dilution that is not accretive to investors today. We'll get there. We'll get that gold, and we'll return it to our shareholders.
Great.
Just different strategy. It's really fascinating actually, because we've debated this as recently as a couple of days ago at the board level, and we're not completely understanding of why the shares trade at 0.2 times NAV. I mean, the value is very clear, but our job is to build value in the business. And you know, this is a conservative strategy to preserve value in the business, which is very different than what other companies might try and do.
Great, thanks, Mike. And Mike, how much of your time are you able to spend on Westvault? I know you've got other things going on.
Sure, I have an allowance from my boards that I can go up to 20% of my time on other companies, and I'm paid a very much part-time management fee that reflects that in terms of Westvault. So Westvault doesn't have a CEO salary and it doesn't have a CFO salary. Both Frank and I have a tiny management fee, and we're permitted under our other engagements to put up to 20% of our time into this.
Excellent, excellent. With that, I'll throw it back to Campbell if there's any other questions from the audience.
Yeah, no, I've got a whole bunch of comments and questions sent in. I'd say let's, Mike, kind of just move on them quickly, and then we'll close. So
Sure, great.
Start with a comment. This has to be the best way to play a rising price of gold with limited downside. Keep up the great work and management candor. Okay.
Yeah. Amen. I think we should end there, Campbell. That's it. What else do we need? I mean, come on, man.
Management candor. Some of this has been we've touched on here and there, but you know, we can always help people with their specific questions. Will you update the PFS to reflect the capex in 2021 materials and equipment and labor costs and operating costs?
We probably won't formally update the PFS, but we will provide ongoing updates on a construction decision. We have looked at the capex and detailed schedule, so we're well aware of potential areas of escalation, but we've also got opportunities. So we're weighing those, and we're not out of the sensitivity range of the PFS currently with today's numbers.
If you decide to go into production, would you plan on funding capex with debt or sell additional equity, a rights offering? If I get that.
So to put some ranges around this, so you know, we've been offered significant debt leverage here. We haven't pulled the trigger on any of it yet. Our view is that we could raise 100% of the capital here with equity, and we probably wouldn't have to leave a lot of, you know, we wouldn't have to go outside a lot of our existing shareholder base, frankly. But that we think that $50 million here to fund this, if we could do that out of 20% of equity, that would be interesting. Beyond that, we would either look for leverage or we may not do it for some time. So, you know, that would imply a $250 million market cap value. At that time, 20% equity dilution to put it into production would be interesting.
Can you tell us what your magic gold price is to make a production decision?
Yeah. We've said that gold should establish a new secular high, and I think it comes down to the previous guardrail that I just mentioned, that you know, we think that more than 20% dilution here is too much, frankly.
Okay, that's it. With that, well, we'll move to close. Thank you all for tuning in. Please share your feedback on exit, and tell your friends and share the replay. It'll be available in about an hour at amvestcapital.com/replays. With that, Mike, I'll pass it to you for a closing statement. And you know, we'll always ask, why buy now? So why buy the end of May and not, you know, September?
Well, I think I'll answer that question right away. I think that the gold price is looking very interesting here. I think there's a lot of investors that would agree. And as was pointed out at the beginning, this is a very good way to play gold with excellent leverage to the gold price and very low risk. So this is a low risk way to get into gold, and it's the right time to be into gold. That's the answer to your question. And you know, I'd really leave it with that. You know, I think really appreciate the work of Amvest Capital getting the word out about us, and you know, it won't take a lot of investor interest to change the fortunes of the stock, given that you know, 70% of our stock is owned by our top institutions.
Excellent. So buy in May and then go away. So
Thanks
buy
a lot.
in May and then go to a webinar later in the summer. So
Adam, great to see you at Amvest. Known the guys
Thanks, Mike.
for a long time. You're at a good shop, and it's nice to see you carrying on in a long tradition of mining research. Good for you.
Thanks,
All right.
Mike. Great to see you
Yeah.
too.
Looking forward
All
to
right,
it as
take
well.
Cheers.
Bye, day,
Yep.
everyone.
Bye-bye.